corporations can become huge icons. They can explode on the scene and grow rapidly, at the same time decline and disappear. But us as traders, how can we look at this for trading opportunities? Let's talk about that. Hello there, this is James, and you're watching Trading Bites. As you know, Trading Bites is like an introduction to topics of trading, giving you little bite-sized pieces, so to speak, make it easier for you to digest before we move on to the bigger courses of the Trading School and, of course, Trades Master. In today's topic, I want to do a fundamental analysis or introduction to fundamental analysis, part 3, this time focusing on stocks. But before I get into all of that, don't forget these little videos are for educational purposes only, and in no way whatsoever should ever be taken as financial advice. I always suggest you do your own research, do your own due diligence, and of course, know the risks at hand before entering any trade. With that out the way, let's get started. So we've done fundamental analysis or introduction to fundamental analysis on currencies and commodities. Now I want to move into stocks. As you know, fundamental analysis is trying to determine if an asset is trading at a fair value, if it's overvalued or undervalued. With the idea, we can try and look into what the future value of that asset may be, proving to be a potential trading opportunity. When it comes to stocks and shares of companies, it's mainly to do with growth or lack of growth. Because when you want to look into investing in or buying a share or stock in a company, you really want to dissect that company's overall value. And there's several things we can look into in establishing a value of a company or a potential future value of a company. First of all, and probably one of the most key things to look at and keep an eye on is earning season. Earning season is when all the big companies, all the tradable companies, release its quarterly earnings. Release at the end of every quarter, surprisingly. And these earning reports, these earning announcements, will show how much that company has earned in the previous quarter and how much their share value has either increased or decreased during that quarter, as well as predictions for the future quarter to come. So obviously it makes sense that if you are, seeing growth in a company and growthful predictions, their earnings come in better than anticipated, it goes to show that company is performing and may provide a potential trading opportunity. On the flip side of that, if the earnings reports comes in a lot less, then of course it's showing that a company is struggling and could provide a potential selling opportunity. As well as that, you then need to look at the market that company is in and that company actually does. What does it do? What does the company do? Is it in banking? Is it in manufacturing? Is it in social media? Is it in retail? What does it do? And then by looking at what that company does, you then look at the market it is in. I mean, how's the retail market performing? How's the retail market performing? Is it growing? Is there signs of growth? I mean, for example, the lockdown, which we all experienced, there was a big increase in people being big increase of people buying things online. Why? Because we were all stuck at home and we were bored. And there was nothing to do other than buy stuff. So there was a big increase in retail purchases. So the retail market did very, very well. After the lockdown, we were able to go in and out again, do our daily lives. There began to be a drop-off in us purchasing things. So again, what's the market doing? What's the market that company's in? How's it performing? And there's another thing, for example, again, using the lockdown example, because we were stuck at home, our ways of communicating was through things like Zoom, things like that. Our business meetings were performed through Zoom. So obviously companies who provided that sort of technology excelled during that time because the market for that type of tech was massive. Then after lockdown, you all could go back to the office again. You could all go out and see the big bad world again. The need for such technology started to wane. So how is that market performing? And the other thing to look at, for example, if you look at, again, say purchases, how's the economy doing in particular? Economic economy. Are we in, we're having a boom market or we're having a bit of a bear market? We are on the bridge of recession because when we're on the brink of recession, okay, we don't have the money to buy luxury items like cars, expensive watches, expensive mobile phones, for example. So again, it's the economic situation. How is the world doing? I'll give you another prime example. The launch in 2022, for example, the launch of the iPhone, I think it was 14, didn't do so well. Why? Inflation was sky high. It was more expensive for people. There was a cost of living, and it still is, as a time of recording, a cost of living crisis. People couldn't afford to buy or purchase such luxury items. So companies like Apple, Samsung, all started to wane and fall under the pressure because of it. So again, we need to look at the market. We need to look at the overall state of the economy. Is there such need for the product those companies produce? The other thing we need to look at is competitors. So say, for example, go to Apple and Samsung again, two massive competitors in the mobile phone industry. If you're looking to invest into Apple, how is Samsung performing? Are they performing well? Which means that Apple could also perform well. So you look at competitors. Or if they're performing badly, what does that potentially mean to Apple? I'll give you another great example, which was happened in 2022. Like I said, I was very active in 2022. Social media companies, which are huge, Facebook, Google, Snapchat. I'm too old for Snapchat, but Snapchat, Twitter. Last year, also 2022, Snapchat released its earnings reports, okay? And it was diabolical. It was not good at all. It came way under expectation. And obviously, the share price or stock value of Snapchat decreased dramatically. But it was not just Snapchat which suffered. Its competitors also suffered. Facebook came under humongous pressure. Google came under humongous pressure. Twitter came under humongous pressure. Because the reason why was because Snapchat was making a lot of money, or potentially making a lot of money from online advertising, online marketing. That waned considerably for them, which affected their overall performance, which meant then the market saw that with Snapchat, said, well, if that's happening to Snapchat, that's going to happen to Facebook, Twitter, and Google, because they rely on online advertising, online marketing a lot. And guess what? Even before Facebook, Twitter, and Google released their earnings, they came under pressure because the general consensus was if one is suffering, the other ones are going to suffer too. And it was correct. So again, you look at what the competitors are doing as well, because if their performance is doing a certain thing, that could potentially affect them. Another thing, again, I'll give you another example, same example, same period of time. I think it was Target, okay, big retailer in the United States. It missed its expectation, its earnings expectation. Again, like I say, because they were doing so well during the lockdown with retail, it waned because of the lockdown had stopped, or they bought too much surplus of content to sell, thinking they're going to sell it, and they didn't sell it. So obviously their earnings came down, which then affected other massive retailers like Walmart and Costco. Again, Target released its earnings, wasn't great. Walmart, Costco, even before they released their earnings, also fell in the market as well. So again, I say, what the market's doing, what the competitor's doing is key when looking at trading stocks. Management. Who runs the company? Okay, because every great company has a great workforce or a great leader. There's a difference between a manager things. A leader takes a company from here to here. A good leader has a vision. I'll give you an example of that. Okay, this is coming back a couple of years ago. I can't remember the exact year. And this is before Facebook bought it. But one of the co-founders of Instagram, one of the geniuses behind the creation of Instagram, announced he was leaving. What did the market do? The market panicked. They thought they were losing one of the brains behind this great this great company which had led it. And the pressure on Instagram's share price was immense because they had lost one of their leaders. So you need to look at the management as well. Who's leading the ship? Who's leading the company? Any introduction to somebody who is well respected, for example, can boost the share price of that company, because the people suddenly think, or the market suddenly thinks they've got a new leader, he's going to take them to, or she's going to take them to new heights. There's a good opportunity for growth. Or if they depart, they think, well, that company's potentially going to lose its way. So again, who's the management? Who's behind the scenes? Who's running the engine? Again, is another important thing to look at when you're looking at trading stocks. The other thing, rumors, takeover rumors. They're a key thing to watch out, or even takeovers in general. Let's start off with takeover from rumors. Now, or rumors of takeovers. There was an incident. Of course, I am British, so I am a football fan, and I am a Man United fan for all my, misery at the moment. There was a rumor last year that the Glazer family, the current owners of Man United, was going to sell their company, their ownership of Man United. This put a load of hope in the market, especially for Man United fans, but put a load of speculation in the market that some new buyer was going to come in to buy Man United. And Man United's share price, based on this rumor, based on this speculation, absolutely skyrocketed. So rumors of takeover can also greatly affect the share price. So you need to keep your ear to the ground and read and understand if there's rumors of takeovers. At the same time, rumors of takeovers can have a slight negative effect. The whole Elon Musk Twitter saga, which happened in 2022. When he announced he was going to buy Twitter, okay, it put a lot of pressure on Twitter's share price. It actually dropped a lot. At the same time, Tesla dropped a lot. Tesla's share price came under pressure. And the reason being, because of this rumor of this takeover, and he took it over in the end. He did take it over in the end. The reason why both Twitter and Tesla, even though Tesla's a completely separate company from Twitter, both owned obviously by Elon Musk. The reason why both share prices came under pressure is because the market took it as if Elon Musk, who also owns SpaceX, don't forget, is going to buy Twitter, Tesla's going to suffer because Elon Musk is spreading his work over too many things, which means he won't be able to focus or concentrate on one thing. So both are going to suffer. The companies are going to suffer because he's not going to be able to, do both. So those companies are gonna suffer greatly. So they obviously came under pressure. Both Tesla and Twitter fell because of the speculation. The idea of this takeover was not going to be a good thing. And finally, again, keeping to rumors of job cuts. Job cuts. When there is rumor that companies are going to start doing job cuts, it's a big indication out there that that company is struggling or beginning to slow down. So there's rumors of job cuts, the share price can be greatly affected. Example of this, obviously we saw a lot of big layoffs last year in the social media companies, Facebook, Snapchat, Google, Amazon being another example. When these rumors started to go that there was job cuts for these companies, their share price came under pressure. So again, you need to look out for rumors like this as well when it comes to company growth. But yeah, those are all the things. It's really a case of like, when you're looking into a company, you need to see what that company does, what market it is in, is there demand for the product or service that company provides, which depends on obviously economic situation, the current climate of the world, the management who's driving the machine, so to speak, who's behind the whole organization and driving it. Excuse me. Rumors as well of buyouts or people leaving or job losses. There's a lot more to it. But when you do delve into it and you do take note and pay attention, it can, present amazing trading opportunities. Anywho, that's an introduction to fundamental analysis part 3 on stocks. Again, like I will underline, I will be doing bigger courses on this in the trading school. This is Jim. It's a trading bites. Give you a little introduction. Give you a little bite-sized piece. Bigger, in more details later, obviously in the trading school. So do remember that. Anywho, till next time, don't forget these little videos are for educational purposes only, and in no way whatsoever should ever be taken as financial advice. I always suggest you do your own research, do your due diligence, and of course, know the risks at hand before entering any trade. Till next time, every single one of you, trade safe.